Hey, welcome to the channel. This is Greg. This is your DLA week in review. Well, yesterday I tried to do a live stream and unfortunately it didn't work out too well. Got some technical issues to work out. It's the first time I ever tried it, and I got to figure out how to integrate my streaming software with YouTube and all this kind of thing. The audio was coming out, but the visual was like locked, so it didn't work out. So I deleted that. So I'm going to do a quick update of the week in review for you right now. Okay, so we had a big rally today. This is the first week that we've been up in about 4 weeks. The market coming into the week was very oversold. Today, Dow Jones was up 823 points. The S&P was up 116 points. NASDAQ was up 375 points, which was 3.34%. Okay, so it was a nice rally within a bear market. And don't be fooled, we're still in a bear market. All of the underpinnings of this bear market are still in place, and we're going to talk about some of those things in this video. Okay, now when you're asking yourself the question, and when you're watching people on television talk about being bullish and talk about, going into the market right now, while you can do that on a case-by-case basis as a stock picker if you are a long-term investor, let's be clear, the direction of the market, in my opinion, is still down. I want you to take a look at some of these charts I have here, and I'm going to sort of show you historically using the VIX and the 𝐦𝐤𝐞, sort of where things are. Take a look at this. Okay, here you see the VIX, right? The VIX is an options measure that measures volatility in the market, and the point I want to make here is that it is a very good predictor of the bottom of the market. Now, just to review what I've said in the past, before we get a turnaround in the overall direction of the market, you're going to have to see this VIX go into a very extended upturn, okay? And I've said on past videos, the VIX is going to have to hit 40 to 50 at least before you're going to see a meaningful bottoming of the market. But let's just take a look at this. Let's go to the 3-year. And you can see, if you go back to the beginning of COVID, when COVID first came out, there was a massive sell-off, right? And you can see the VIX in March 2020 got up into the 80s. It got actually as high as 85 at one point, which is just incredible, right? And you can see now it's only around 27. Okay, so just remember what that looks like, and then let's go to the 𝐽𝐽𝐽, and you can see the 𝐽𝐽𝐽 bottomed almost exactly in the same point that the VIX had that massive rally upward. Okay, this is where you had extreme selling, you had panic selling, huge volume, and this is what we really need to get to wring every ounce of bullishness out of the market. Okay, and when that gets to that point, you're going to see extreme bearishness. I mean, everyone's going to be bearish. You're not going to hear guys on television talking about how they're bullish, like you have recently. You're not going to see that. Everyone's going to be uniformly bearish, as well as the Fed has to also capitulate in the sense that they have to panic and they have to start easing up on monetary policy and even providing liquidity to the market. Then the market has turned around, and I'll keep you updated on that, okay? I thought another interesting thing that happened this week was the Powell testimony, and Powell went before Congress again and was grilled and mercilessly attacked, so to speak, and he was it was kind of difficult to watch, and I didn't watch all of it, but very interesting thing. One of the senators asked him, this Putin price hike, do you think the war in Ukraine was the cause of inflation? And Powell said, no, I don't think that was the cause of inflation. Inflation was well underway before that. Okay, I thought that was very interesting, kind of refuting everything that Biden's running around, you know, blaming inflation and gas prices on Putin, calling it the Putin price hike. I got a couple things here that'll be interesting for you to take a look at. Take a look at this right here. Here, first of all, is the U.S. retail gas prices. Okay, let's go back in time, and you can see, let's go back, all right, 3 years. Here's where Biden came in, right? Biden came in, gas was at $2.33. This is when Putin invaded Ukraine in February of 2022. There was already a 50% increase in gas prices from when Biden took over to when Putin invaded Ukraine. Then, going from that point in time to today, where average gas prices are around $5.10, that was another 45%. Okay, so by the time Putin attacked Ukraine, gas prices had already gone up 50%. Okay? All right, so that's not exactly 100% truthful there, bud. All right, and then let's take a look at inflation, all right? Inflation, as you can see from this chart, all right? Biden came in, and I'm not going to go back in this, but he came in, and the first thing he did was the American Rescue Plan. That unleashed another $1.9 trillion into the economy, in addition to all the money that the Fed was printing at that point in time, $120 billion a month. So by the time we got to here, it was already 5.4% inflation. Okay, so July, August, September. So inflation was already rapidly rising starting in October. I mean, it was already 5.4%, which is extremely high. But then it rises 6.2, 6.8, 7, 7.2, 7.9. Then Putin comes in February, and it goes from 7.9 to 8.5 to 8.3 to 8.6. So obviously, inflation had already taken hold way before Putin came in. So this is like not very accurate there by old Joey boy, okay? Joe tends to exaggerate, tends to say things that are just basically not true for political reasons, okay? I'm personally getting a little tired of it, you know, insulting our intelligence, but this is the way he chooses to conduct himself and his administration. Next, I want to talk about energy, okay? We've been very bullish on energy on this channel. Recently, prices have been selling off rather extensively in the oil sector around some of the narrative that's been going on in the market. And, you know, energy prices are very volatile, so that's no surprise. What I want to do in this video is just go over how I feel about Exxon and another one that I looked at, which is Google, another one that I've been recommending. So let's take a look at those two charts right now. Now, I did a video when Exxon went above 100 to 104 approximately, and that was around in this period here. I said specifically on that video, do not buy it here because it's massively extended. Since that time, it's gone down about 18%, okay? And it's down around here. So it closed, you know, close to 87. It's down 17 to 18%, right? So one of the things I just want to say is that I believe that everything is still in place in terms of the underpinnings supporting oil and gas. And I point to another data point that happened this week. Berkshire Hathaway, headed by Warren Buffett, invested in excess of another $500 million in Occidental Petroleum. They now own over 14%. And so I think that is a vote of confidence to the sector. Arguably the smartest investor in the world is expanding their stake in Occidental Petroleum. Of course, the two picks on this channel are Exxon and Chevron. And I think I'm at the point now where I would buy the dip on Exxon. Okay? Let's take a look now at Google. Google, I came out with a video right around here a few weeks ago where I was recommending buying Google before the 20-for-1 stock split. The 20-for-1 stock split will not create any value in and of itself, but it will create more liquidity in the stock, and people tend to go into shares when the share price is lower. Right now at $2,300 a share, it's difficult for people to go in. But when it gets down to $116, $120, whatever it will be easier for people to buy. So therefore, I think that it is a good move, given the strength of the company, to go in before the stock split, which I have done. My cost right now is about $2,100 a share. It's gone up since then. I bought down in here somewhere, but it's gone up since then. I would continue to watch that and buy in before the July 15th date that it's going to split. Okay, so one of the things about Google, Alphabet, that I wanted to mention is that there is some political risk in this stock, and I am going to be doing some research on it. There's a couple bills floating around Congress that are trying to disassociate some of Google's business practices from their advertising business, which of course they control like 90% of digital advertising vis-a-vis their search engine and other products. One of the reasons I like the company is their dominant market share and the moat that they have around them and their consistent history of growing their earnings. That's the reason I like the company. It's the reason why some people in Congress do not like the company, because they think that they have an uncompetitive market advantage. So over the next couple weeks, I'm going to do some research and sort of determine what the probability is that any of these bills floating around will see the light of day. Google has a very strong, and the rest of the tech companies have very strong lobbying efforts. So since they fund a lot of these politicians' political campaigns, we'll see how much influence they have to try to derail these efforts. But there is a political risk hanging out there, and it's probably one of the reasons why several weeks ago the price was very strongly depressed, and that's when I went in. Okay, I realize I'm taking some risk, but we'll monitor it on this channel. Okay, so to summarize, this week we had a very nice bear market rally. I would not take this as indication that the market's turning around. We still have all of the same underpinnings in place that we had before. We have tight monetary policy. We have the Fed reducing liquidity by reducing its balance sheet. They're stopping printing money and manipulating the bond market. All of this is negative for stocks. We still have the war in Ukraine and a horrible geopolitical situation. And we still have a domestic situation where the president is still absolutely not committed to increasing either refining capacity or drilling capacity. This was evidenced by this week. The major CEOs of the oil companies came to the White House and met with Jennifer Granholm, and Biden was there, but instead of meeting with them and trying to figure out how we could work together to improve the gas situation and or the oil situation in general, he was meeting in the other room with a bunch of windmill people, okay, the wind lobby. And he's talking about how, you know, wind is the answer to the energy problem. Okay, as long as you have a leader or a president like that, the political situation is not going to change in Washington toward oil and gas. So for all those reasons, I'm still bullish on energy. Energy should stay above 100 for the near-term future. As the economy or the situation changes, we will reevaluate that position. But for now, we're still all in on energy, and we're nibbling around at some of these other growth stocks from a valuation standpoint, as it might be a long-term entry point to get into these while their valuations are still low. Okay, well, I hope you enjoyed this weekly update. I will continue to do them, and I'm going to try again next week to do the live streaming of my views here in real time after the market closes on Friday. Hopefully I'll figure it out between now and then. I got to think I will. So until next week, I'll see you. If you got value out of this, please like and subscribe and hit the bell so you get notified as I come out with more videos, which will be coming your way very soon.